Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today, we're going to talk about the anatomy of a real estate deal. That's right. I'm going to go step by step so you can understand how we do real estate deals. Because a lot of people are confused. They think it's hard. But there's estimates. There's investigations into how much it's going to cost you, what your NOI is, all this. We're going to talk about it from scratch. So stay tuned and please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, welcome back. Real estate deals, the anatomy of real estate deals. All right, so I'm about to give you guys some more game on how you can get deals sent to you, and I'm going to give you the name of a Jim Haven. But I want to welcome everybody, any new subscribers, any new watchers, any new persons that have stopped by this channel. Thank you very much. Thank you for your support. Real estate. Everybody wants to get in it these days, but it's not that easy. But we're going to talk as if you're looking for a real estate deal. As you can see here, we're on the Stop Struggling Now YouTube channel page, and we're over 4,000 subscribers, so thank you very much, everybody. Here we go. So, Jim Haven. He's like a real estate agent, investor. You guys, I'll have his email address down below. He deals mostly in the Ohio, Cincinnati area with multifamily properties. So this, as you can see on the screen, there are some of these are redundant because they're inbox, outbox. I deleted so they all show up. But you can see Jim Haven sends me real estate offerings all the time. I'm on his list. This is what I was talking about in previous real estate videos where I said, you know, you got to contact people so then you're on their list, or they have a way to contact you when properties come up. And the thing about Jim Haven is he actually runs the analysis for you, so it makes your decision a lot simpler, because this is what most investors would go through. But because he has a sheet, I'm going to show you what he sends over along with how we can determine if this is a good deal. Now keep in mind, when it comes to real estate, everybody has their own thresholds of pain. Some people look at real estate differently on how they're going to make the money, because remember, in real estate you make your money when you buy the property on the entry point. The reason why? Because you already know how much you're going to make and you already have a plan. So those are the kind of things that we're looking for here. You already know that. So that's the beauty of real estate. You do not buy real estate without having information first. In other words, just because somebody tells you that they make 10% and they use terms like cash on cash, are they really making 10%? I mean, it depends on what you're looking at. All right, I look at 10% differently than another person may look at 10%. And some of you may say, hey Eric, I don't, how can that be? Well, I'll give you a perfect example. I'm about to use an example where I'm about to say, if I buy a property for $100,000, $1 million. All right. And then somebody says, okay, in order for me to make 10% a year, I need $100,000 profit per year. That would make sense, right? That would be 10%. To me, that's what 10% would mean. But other people may say, okay, I didn't put down $1 million. I put down 25%. I put down $250,000. So if I make $25,000 profit, that's 10% of the money that I invested. So it all depends on how you look at things, and it depends on how you look at things, it's how you're going to invest. So if you feel fine with putting up $250,000 and making $25,000, good. If you feel fine about buying $1 million property and your threshold is I need to make $50,000 a year, then that $250,000 out of your pocket, that doesn't look good for you. But if you're saying, hey, I'll take the $50,000 a year for my $1 million investment, then that's good for you. So see, it all depends on what's good for you. It doesn't matter what's good for me. It doesn't matter what's good for anybody else. It's your deal. You're making the deal. You're writing the deal. You're writing the offer. Now all you have to do is make sure that you close as many loopholes as you can. So we're going to talk about it. Let's start. I got to close some things out while we're sitting here, because I got, always some Airbnb stuff going on. All right. So here's what we got. Where do I want to go? Okay, Jim Haven. I already went there. We're going to leave that down. We're going to deal with this 2365 property on Raven Street, and it's in Cincinnati, Ohio. And the first thing, when he sends me over this, I have an address. So I look at the address. Now you can see just from Google Maps, University of Cincinnati is up the street. So you know what this means. University students, this is why they have 1-year leases to university students, which would make sense, right? So once you see that, how close it is, it's almost like, and there's Niepert Stadium, but once you see how close it is to the university, it's almost a foregone conclusion that you're going to be renting to students. Now, this is 3-bedroom and 2-bedroom apartments. All right, which means there could be 2 roommates. So now we have to determine things. Let's say we have to know about how much the place rents for. But here's what I did. I started clicking because I want to know the history a little bit, right? So with real estate, you have to do research. So I see this Redfin thing here, and I'm sitting here like, okay. So the guy last sold $490,000 in 2014. Now, I haven't really looked deeper into this to see if he sold it since then, but $490,000 for a 13-unit apartment complex. Some people like to divide how much that's going to cost. So, per unit. There's all kind of little things you can do, but I don't really look at these numbers that much because it all depends on what the profits are. So we're talking about almost $38,000 per unit, which would be a damn good deal, especially when you're renting it at $700 a month and or a little higher, and 700 times 12 is $8,400 a year for a $38,000 property. Now it all depends on your expenses, and that's a pretty good ratio. If you can get, like I said, you start thinking about the money. Even if 50 to 60% was gone due to expenses, you're still doing 10% of the volume, 10% profit on your money per. So you're doing pretty good. So that looks pretty good. The only thing is, I'm going to tell you the sales price right now. The guy wants $1 million. So this isn't a bad deal. 2014 he buys it. He fixes it up. Makes it look a little better from the profits, reinvesting in the real estate. And then, what is this, 6 years later, he's trying to sell it for $1 million. Why is he going to be able to sell it for $1 million? That's the big question, right? That means the rent had to increase. There has to be a low occupancy rate. So we'll find out. But just keep in mind, this is not a bad deal for him. He's doubling his money. So now the question as a buyer is, if he's asking $1 million, are you going to pay $1 million knowing that he bought it for $500,000? So you might be able to squeeze him down a little bit, because when somebody bought something for $500,000, they've been making a little profit, and then you never know. He might take off $50,000 to $100,000 or more. You just never know. But then again, it goes by your numbers. Your offer goes by the numbers. So if there's not enough profit, you're not going to offer the guy anywhere near $1 million. So let's move on. Let's get into the deal. Here we go. So, like I said, Jim Haven. This is what he does because he knows what a real estate investor is looking for. So he runs the analysis himself. Even though, now keep in mind, this is his analysis. It's not my analysis. But let's go on. Here's the deal. This is what this is all projected, but it's only projected from the fact of if you're going to look at multifamily properties, you can't go by unknown information. So when somebody says like scheduled income of $144,420, your first question is, I need to see your rent rolls. Rent rolls is basically what the renters are paying. They're going to send it over to you what each tenant is paying. They'll usually give a name, apartment number, and the amount their rent is, and then it'll say a 1-year lease, 2-year lease, or whatever the case may be, or month to month. So that way you know. That's what you want anyhow. Whether they give it to you or not, it's a whole nother issue. About what I'm saying is all those items you want to check the box off because you want to know if a person's on month to month. You want to know if a person has a 1-year lease or a 2-year lease. You need to know this kind of stuff because now you need to figure out your vacancy rate, and you need a low vacancy rate to make money in multifamily properties. So let's start out. 144,000. There's only 13 units. He's basing this all on vacancy rate of 20%. 20% on 13 units is going to be about 3 units would have to be vacant. So now you have to ask yourself, here's Jim sending me something right now. But now you have to ask yourself, what about the vacancy rate in Cincinnati, Ohio, period? Right? So Google's your friend. So what do? You Google. You need to find out the vacancy rate. You need to find out the average rental rate in Cincinnati. And here it is, just off of Rent Cafe. So they're saying average rent's $1,000. It went up 6%. And last updated November 2019, 869 square feet. The bulk of property rentals are in $700 to $1,000. All this is very good information that you should know. But the main thing I need to know, and the main thing that I look at, I need to find out what the occupancy rate is, right? So here's these guys talking about the average rent, and we know it's in Clifton, right? In the Clifton area. So let's see what the rate is. The rent, Clifton. So they're saying $897 a month. All right. So if your rents are around that, and it should be, seeing how it's around a university, even if you want to give somebody a deal, $850 a month, you got 13 units. So now you can start extrapolating on your own self and say, okay, but some of these are 3 bedrooms, so I can't really say. But we'll go with 13, even if we're 100%. 11,000. A 3 bedroom, you're going to be able to charge more. So this is how we get up to $12,000 because there's I don't know the mix though, but we'll deal with that later. That's not what we're talking about today. So he's talking about roughly $12,000 per month. So that means the 2 bedrooms and 3 bedrooms combined, that's what it's doing. He knows the rent rolls. He knows how much the landlord's receiving. And then, by the way, when somebody tells me these kind of numbers, that's fine. But my first thing is you need to send me over your tax statements, IRS tax statements, certified copy by your CPA, because I'm not believing. If you tell me that we have a profit, let's go down here to the NOI. Where's the NOI at? Expenses 54, net operating income 76,000. Okay. All I know is I better be seeing something on your tax return talking about $76,000. And then you can tell me the expenses after that, or trying to figure out a depreciation or whatever you're trying to do after that. But I better see something. Because if I don't see something matching what you're telling me that the property makes, then I don't believe what you're telling me. So keep in mind, I try to get that information as well. And when somebody's selling multifamily properties and doesn't want to give up their form from their IRS and is certified by a CPA, because if it's incorrect and they lie to me, then I can go back and do some lawsuits if necessary. So the point I'm trying to make is you double check and triple check, not only because Jim is sending me over his analysis, but I need to see the rent rolls. I need to see an IRS, their actual IRS documents that they filed for this property. All right. So those are the first two things I'm asking for. Forget the okie doke stuff. All right. Interestingly enough, he bases the occupancy rate on 20%. Now, we were talking about occupancy rate, and I didn't get to it. I actually know what the number is, so that's why I probably skipped over it. But let's see here. Need to drop this back down. 10%. All right. Beth Acres, Avondale. This is the rental rate. Okay, Rent Cafe. No love for the rental rate. All right. So now, U.S. rental rate. Rate trends. Let's see what we got. And this is on managecasa.com, metropolitan area, first quarter. This is only first quarter, it's not a full year. So first quarter in the Cincinnati, Ohio, 11.5%. So his 20% analysis, it works for me. His 20% vacancy rate, because if this is 11.5 first quarter, that's fine. That's a pretty high rate to me. The national average is in single digits. So I'll live with that, and I'm going to live with it's up the street from Cincinnati, which gives me a higher occupancy rate than probably any other place in the city. So that's what we're talking about here. All right, so let's get back to what we're doing. So I can live with the 20% basis, plus other income. Now, of course, I would have to talk with Jim and further find out what this plus the other income is. This could be that's $14,000, almost $15,000. There could be some sort of rentals, like storage rental. There could be something like washer dryers in there also generating income. So he's got a gross operating income after all said and done of 130. That's what he's basing this on, and it's actual because there's 3 units of it, unoccupied right now. So this is actual. Again, now we go with expenses. So he's got it all down here: the taxes, the insurance, the gas, electric, water, sewer, waste removal, maintenance, repairs. He's putting in a reserve. Notice this replacement reserve here. All right. That's very important when you have multifamily properties because something always happens. So you should always have a reserve. Okay. Put it in there. You'll save yourself a headache later on. Based on auditor's valuation, 439. Project tax after sale, 32. Total expenses, 54,000. So basically subtracting the 130, 54,000 comes into 76,000 is your NOI, net operating income. That's after everything you've received, your expenses. Cap rate is 8%, decent. There we go. Net operating income, 76,000. Now, if you put down 25%, I'll go over here to this side. Look on the right-hand side, over here. He already has it figured out for you at the 25%. He's coming up with this principal, interest, taxes, 25-year term, $4,000 a month, and that's where this number comes from, $49,000. So after you pay your mortgage and everything, you're looking at $26,000. That's for a year, not a month. So in essence, after everything is taken care of, you're looking at $2,000. 23, 20, it's 2,000. Let's call it, because 24. So you're looking at around 2,200 a month in your pocket, cash flow wise. Is it worth putting down 250,000 to get a cash flow of 2,000? Some people would say no. Other people would say yes. The reason being is because the rental income is paying off your note. So you're still ahead of the game. And you have reserves already calculated for repairs. And you have the maintenance like he's doing, and management at 7.5%. He's got it all in there, which is all calculations that you need to know, because if you forget that you have to pay, what is this? These two, well, let's just call these three things here. What is that, like $22,000? So if you forget to calculate that, and then you figure, well, instead of that, I was going to make $36,000 a year, you might be finding yourself short. So every expense you have to account for. All right? And then save yourself with the replacement reserve as well. And by the way, the previous owner he does probably have a replacement reserve as well. And quite frankly, I ask, doesn't mean I'm going to get it, but I always try to figure out some percentage of the replacement reserve as well, because I don't want to move into a place or buy a place and then instantly have problems. So I try to get some of the replacement reserve. And with that said, you always have to do an inspection. Multiple inspections. You're going to have heaters. You're going to have AC units. You're going to have plumbing. These are major costs if they go wrong. Structural wise, looks like a brick place, that's fine, but you still need to check all this. So you got to pay for the inspections. They're relatively inexpensive for when you're buying millions of dollars worth of real estate. You're not going to mind spending $400, $300, $500. All right? The only thing you might mind is spending money for an appraisal. Depending on how you're financing this place, that will depend on what you're going to be doing with your appraisal. And your appraisal has to come back obviously at $1 million if you're buying it for $1 million. Or in this case, he's saying negotiated price could be $950,000. I agree with this assessment. That's why I told you before, $490,000, and the guy's doubling his money. You could point out, say, hey man, you've been making, profits. Why don't you, I'm trying to get this for $900,000. It makes sense for my numbers. Or $850,000. It all depends on what you think this profit of $26,000 is worth. I personally, I don't really like the $1 million price tag. I like it like $800,000 price tag. Of course, as a buyer, that's what I would say. All right. So now he goes into other computations and calculations. And of course, there's depreciation on properties that you can, for your tax purposes, get deductions for. And here we go. He's using line 32 here. He's talking about $27,000. There's all kind of depreciations, all kind of little tax savings you can do, because why? You own real estate. But just keep in mind, I don't want this to be too long, so this is the point I was just trying to make, is that you have to understand your income statement, your cash flow schedule, as he points it out, and then we're getting into the return on equity, which, by the way, like I said, they're calculating this over here, and you could see where this is running, the 12%. And so again, he's basing it on $237,000 down. $26,000 is 12% on your money. That's where they're coming up with this. And again, some people say, okay, I'll take this. I'll do this. Everything's covered. I don't mind getting 12 or 10% on my money. That's it. The basis of buying real estate. It's all about the numbers. And somebody that's watching this could say, hey, let me call up Jim right now. I want this property. Or they'll try to negotiate for the property. So then here's what gurus don't tell you. All right? This is the no guru zone. So I can tell you to come to a seminar. I can tell you how to buy property. I can show you what Jim calls his real estate investment analysis. I can show you all that. You can do all that. So this is the easy part. We can find deals. But what the gurus don't tell you is that $237,500, most people in America do not have that kind of money sitting around. This is why the wealthier keep getting wealthier. Because if they want to do the deal, they have the money, and now they then taken another building, another multifamily property off of the table, and ordinary citizens are left renting. So when you find out hedge funds, banks buy up properties and take them off the market and they just collect the rent and they just keep doing it. So the gurus don't tell you about that 237,500 and where to get it. They always have some sort of deal. Let me go. I need to go do something here because I keep having these screens pop up. They still have these deals where okay, I lost my train of thought though. But anyhow, they keep having these deals where they have the you can do everything. No other people's money. Go ask for to borrow from friends, family, or whatever. Like I said, $237,000 is why you need to find investors sometimes that would go in with you, who would say, okay, give me 5% on my money, which we already have built in from Jim's analysis. So now Jim made it easy for you. He says, did I lose it? Jim makes it easy for you. You can now show a potential investor. You say, hey, and now you need not only the 237, but you're going to need that outright, 25%. Now you need 750 or 712,500. Who's going to fund that? Who's going to finance this? So you need the whole thing. And this is where the gurus never get to. It's easy to find property, not easy to find the funding. And then they go one step further and say, oh, don't worry. We can get funding for you. You'll use our own special in-house funding program. This is after you then gave them the 1,000, the 1,500, the 2,500, or 5,000 or more. And then you find out that you have to qualify just like anybody else, and that they don't have these so-called secret investment programs that somebody's going to give you $712,000 because you showed up with the property that shows that there's a positive cash flow and you can pay for it. It's not that simple. But anyhow, this is the anatomy of a real estate deal. I just wanted this to be short and sweet, and these are the kind of things you look for. And now I'm over at Arbor. Before we go, is that rate we're looking for, right? That vacancy rate. So here's the sales cap in the Cincinnati area. As you can see, I don't know if you can see it on the screen, but right in there, Cincinnati multifamily. People go by cap rates. And they're talking between 5% and 2.5% in 2019. The rental market, it's the same that we were talking about. They're talking about in 2019 it was $949 for basically a 2-bedroom apartment. So that's a good sign. And let's go here. Employment numbers trending down, as with the United States of America, trending down, but it's only because of the way they calculate unemployment. So don't trip off of these unemployment numbers, whether it's by the U.S. Bureau of Labor Statistics or anybody else, because people fall off the unemployment roll and they count them as like got a job even though they didn't get a job. So it's crazy. All right, so where are we at here? I didn't see my 11.9% vacancy rate here. Oh, vacancy rate, here we go. They're claiming 2019 under 6%. So here's our magic number, under 6%. And Jim was kind enough to, be very conservative and do 20%, 3 times the vacancy rate. So needless to say, because they have 3 units available right now, should only have 1 unit available or less during the year. And again, from what I understand, for this property, he has 1 year leases for students or for everybody. Some people might have more than 1 year, but I think everybody has a 1 year lease on this. So, and the reason why is from school year to school year leases, which is very good. So again, by all metrics, it would seem like it's a good property to invest in for someone. Me personally, I wouldn't do it. Not that it's bad or good. It's just that I don't like how it's set up, and I don't really. It's 13 units, and that's fine. 13, and I don't advocate anybody trying to do 60, 100, 200, things like that, unless you're familiar with real estate deals. But again, 13 units is small enough for somebody to get started in, and it could be you, somebody watching this video right now. So you can give Jim an email. His email will be down in the description below, and you can get on his list. And that's not the only thing he sends. I mean, that's not the only one he sends me. You can see by the emails that he sends me something generally like every week or two. So there's plenty of multifamily, and the reason why the Midwest is always a good spot is because, as you can see, in 2014 when he bought it for $490,000, you can see why the property values are so low in the Midwest, whether it's residential or whether it's multifamily. And this is why you see a lot of real estate investors doing very well for themselves when they're in the Midwest or even in the Southeast or the South, because property values are so low. You go out to the West, starting around Arizona, Nevada, California. In the West Coast, this same 13-unit apartment complex will be almost double. So it would probably be $2 million or $3 million, because I didn't show you. I should have shown you some other things that I get from Arizona commercial brokers, and they have like 10 units for $2.5 million. It's just crazy. So this is why you can make a lot of money in multifamily and commercial real estate, but you make your money when you enter the market. When you buy the property, that's when you already made your money, because you know what you're going to be doing with the property. Just like ways to increase a property's value, if the average rent is $949 for a 2-bedroom in Cincinnati, then, and my rents are under the $949, that's average. So now that means I can rent my place, let's just call it $950. Let's just call it what it is. We'll do the numbers right now to see, so you can see. $950 times 100% occupancy could be the estimated. That's where his $12,350 comes from. And by the way, like I said before, the reason why I know these numbers are right, because he has the rent rolls, and a 3-bedroom would probably rent for more than $950. So that's how, on the average, the 2-bedroom and 3 bedrooms combined. And if I did this times 12, his estimate was $144,000. So we just raised our estimate up $4,000, even if we went across the board and said, okay, a 2-bedroom unit is $900 a month, or $895, and a 3-bedroom unit is $975. We just gained ourselves $4,000 worth of profit per year. Divide that by 12, it's only $400. But still, nonetheless, any additional increase in rental income increases the value of your property. So those are the kind of things that you're looking at. And these are the kind of things if the property is rented under value, then now you have another reason to get into this property, because if you can increase your revenue by $4,000 or profit by $4,000 by going in, and you know this already, instead of that $26,000 profit a year, you know you're going to be at 30. Now things are looking a little bit more interesting. And look at the trend in Cincinnati. It's trending up. So imagine the increase. So it went from 915 to 945, which is almost a little under 4%. So if it increases another 4% the following year, you're going to be at $1,000. So in about 2 years, you'll be able to raise your rent up another $40 a month, $50 a month, if that trend continues, which now means your property's worth more than it was the year before or 2 years before. So that's it, ladies and gentlemen. The anatomy of a real estate deal. This is how you start. And if you have any questions, you can always email me at eric@stopstrugglingnow.com. And some people do have my phone number, so you can call me. But if you call me, just text me, because I get phone calls all the time and text all day long. So let me know if this is helping you. Let me know if you understand what I was saying. I'll do a part 2. I'll do another actual property that I really like, even though I do like this one. I shouldn't say I didn't like this one. I do like this one because there's an upside. And that's the reason why I would look to invest into this. So anyhow, with that said, thank you for watching. Thank you for listening. And please like, subscribe, and click the bell below so you get the latest updates. And you know it's hard out here. You should be stacking cash. Disregard the real estate, the stock market. Disregard the numbers. They've reached record highs. A bunch of people, companies have reached record highs. There's only one way to go, and that's down. No matter if the feds are doing QE, quantitative easing, they're liquefying the banks so they can do more of this bubble. Sooner or later, there's going to be a crash, and you should be getting your golds, your silvers, your precious metals, stacking cash right now, because he who has cash in his hand is going to be king. And by the way, I said this before in a previous video, I'm not talking about stacking cash in a bank. Banks don't even have money. Like I said, try and go down and tell the bank I need $15,000, $20,000 today. See what happens. And I'm not talking about robbing them. I'm talking about go in there and say, hey, I need to withdraw, or I have a check for 20 grand. Can you cash this? They're probably going to tell you, come back, we don't have this money. That should tell you right there. You do not want to keep your money in a bank while you're stacking it right now, because you might want to look at Hungary, other countries where banks closed, ATMs shut down. Citizens can't even leave because they can't get their money. Credit cards chopped off. So you would say, hey, I got to leave and go to America. Go somewhere else where I can get paid. I got bills due. No. You see my point? Like I told you guys before, my grandmother was sitting there when I was like 8, 9 years old with her friends, and somebody said, hey, I'm going to leave my, I'm going to deposit my check today at the bank. And everybody erupted. They said, what? What are you talking about? What do you mean you're putting your money in a bank? No. Since when? You know the banks are against us. My grandmother lived through the 1930s, the Great Depression, when banks stole everybody's money, where the U.S. government said, we're keeping the banks closed, called the bank holiday. People could not get money out the bank. There were no ATMs at that time. We're used to ATMs now, but imagine you put your ATM card in and it's not spitting out money. Banks are closed because there's going to be a run on the banks, because now everybody's going to want their money. They have bills to pay, food to buy. So I'm just saying, that's the dark times, but this is Stop Struggling Now. You have to think about your future, your family's future, and I'm just trying to say, do not put all of your money in a bank, liquid money in a bank, and get your precious metals. And in fact, even get a little crypto, but stay with the main guys, the Ether, the Litecoin, the Bitcoin, the BSV, whatever. The altcoins, they've been taking a beating, but hell, if something happens, even altcoins will come up if your money's taken. So, with all that said, thank you for watching. Thank you for listening. Keep your head up. Keep moving. And I'm out.